Welcome to the Defence Property Podcast, the podcast where we talk about all things property investing and real estate for Australian Defence Force personnel. Whether you're looking to build and scale a property portfolio or relocating across Australia, we've got the insights and tips for less stress and more success. Let's dive in.
And welcome back to another episode of the Defence Property Podcast. I'm pretty excited about today's episode. We have Terry Ryder from Hotspotting, arguably probably one of, would you say, the older property research companies in Australia, Terry?
The Hotspotting business has been going for just on 20 years, and we're undergone quite a period of expansion over the last, say, 2 years. More people, but in particular, big focus on expanding the offering on our investor portal on the website, trying to become as much as we can a one-stop shop for property investors seeking data of all sorts about locations and individual properties and good places to invest.
Excellent. Well, welcome to the podcast. I'm excited for today's episode, so thanks for your time.
Sure, no worries. Always happy to talk about real estate markets across Australia. As I often say to people, the hard part's getting me to shut up. So.
Yeah, excellent. So I guess take us back to, before we get into sort of the episode and what we'll talk about today, just take us back to the start and give us 20 years compressed into a few minutes of Hotspotting, where you started and we'll go from there.
I started the business in the beginning of 2006, so just coming up for 20 years, because I kept getting asked the same questions as a researcher and writer of many years on real estate and previously specialising in that subject. The key question I kept getting asked is, where's the best place to buy? So I decided to conduct a study on what were the characteristics of the outperforming markets, because at the time there were a number of markets which would do much better than the average across the country, and I did some research to determine what features made them outperformers. And so created a website out of that with reports that identified the best places to buy using those sort of background principles of what creates outperformers.
Yeah, excellent. As you've grown, you've sort of now you specialise in a lot of written reports on the fundamentals like population growth and infrastructure of major areas, but also go down to the data as well of individual areas and suburbs.
Yeah, and it's really interesting to look at the areas that have outperformed. Quite often the best capital growth occurs in places that people might not expect. Ugly real estate grows in values often more so than the prestige stuff. In simple terms, that's because the vast majority of the buy demand goes to the affordable areas, provided they have all the basics that people need, all the basic infrastructure that's important in people's lives. And we might all aspire to live in, the swanky suburbs of Sydney, Melbourne, or the Gold Coast, but most people can't afford them, so they buy where they can afford, they rent where they can afford. And that massive demand, and we right now have particularly elevated buy demand at a time of shortage. That demand drives prices ever higher.
Yeah, so it's quite a myth, I would say, or a very common myth we come across quite often is the capitals outperform regionals, when it's simply just not true if we look at it on a pure percentage of asset movement rather than price. Would you? Yeah. Very,
very true. Indeed, the usual suspects, the big property data firms that often publish their lists of best performers, and Cotality, formerly CoreLogic, published one early this year. Where's been the best capital growth in house prices in Australia 5 years up to mid-2025, and the top 10 in the country were all regional. In fact, what they had in common was they were small to medium-sized regional centres with strong diverse economies, which we think is important, significant investment in new infrastructure, which we think is very important as well, a level of affordability, and also an element of lifestyle in the mix. So those were the key common denominators of those outperformers, the top 10 for Australia. And that makes perfect sense to me, because that's what we've been observing for a long time in terms of where you get the best growth. And that's great news for investors, because it means that the areas that people can typically afford, and which also provide the best rental returns, are also the places that provide the best capital growth. So it's a bit of a winning trifecta for investors these days.
I'd love to get your thoughts on one topic that we come across a bit. Quite often we speak with property investors and buyers, and they've spoken to some sort of property group that's selling a house and land package, and obviously there's potential conflict of remuneration in these models and stuff, but they sell on the promise that it's a growing area. They're building infrastructure here, they're building roads. It doesn't have Bunnings or McDonald's yet, but they're coming soon, and they sell these areas on a growth region rather than the underlying dynamics like supply levels, demand levels, and stuff. What's your thoughts on an area that's growing with saturations of supply, I guess,
Yeah.
versus somewhere that's fully built out, like a more older suburb that's fully built out and it's got all that infrastructure already, but the dwellings might be 20, 30, 40 years old. What's your thoughts in the comparing the two? One's growth of price, but one's growth of region, but they're not, I guess, equal.
Yeah, I think there's a bit of a trap there for investors. The areas that have the highest population growth are often, they achieve that simply because they're the areas with the land available for new development. So they're the new development areas which typically have the highest percentage population growth, and that can be misleading because they can also be places that have a high level of new supply, and that can create sometimes oversupply, which tends to suppress our price growth. So, and conversely, areas that aren't showing any price growth or not very much because they're established areas with no scope for new development are often the places that provide the best growth because there's heavy demand and there's no capacity for a high level of new supply to be created. So the population growth theory can be quite misleading. I think people should be looking at other factors, and we certainly do. We do take into account population growth, but it's certainly not the be all and end all of our formula.
And it's just one ingredient of a bigger picture.
Absolutely right. We have what we call our empirical formula for assessing areas. Empirical evidence means evidence that's based on actual experience, on factual experience rather than on theory, but empirical in this case is also an acronym. So each letter of the word empirical stands for something important in our philosophy. The E is about the economy. We want the economy to be strong and diverse. One of the I stands for infrastructure, investment in new infrastructure, which we think is incredibly important because it's a great generator of outperformance in real estate markets because it creates so many jobs and economic activity, and from that comes demand for real estate. The L is for low risk. The A is for affordable because affordability rules more and more, and Australia's harder and harder to find as prices just keep on rising. So those are some of the factors that are part of our empirical formula that we look for. The P does stand for population, but it's not. It's just one of 7 or 8 factors that we look at to assess an area.
Excellent. And as we record this, it's in mid-December, and the episode should be live in the weeks that follow. But I guess the first topic that I'd like to get your thoughts on, the year in review of 2025, just some commentary of what your key takeaways were. I feel that 2 was the affordability piece and regionals outperforming capitals.
Yeah.
And the bottom quartile, again, outperforming the middle and the top, which comes down to that affordability piece. But what's some of your 2025 year in review thoughts?
I suppose the biggest one is that we have growth in buyer demand and growth in prices in all the major market jurisdictions across Australia. So, we tend to look at Australia in one sense in terms of major jurisdictions. That's 8 capital cities, 6 state or territory regional markets. So there's 14 major jurisdictions. And that's how PropTrack and Domain and Cotality also frame their price data. Now, right now, in the last month, but also in the last 12 months, every one of those jurisdictions has had some level of price growth, which is unusual. In my experience, there's normally markets that are booming, some that are moderate growth, some stagnating, some falling. But right now, unusually, we have every single one of them with some level of price growth. According to the Cotality figures, over 12 months, the lowest is Hobart, which is up a fraction under 5%. And all the regional markets are also up. And that's also true for the unit markets, not just for the house markets. As you've pointed out, in both cases, both houses and units, the regions are rising more collectively. The combined regions are up more than the capital cities. But all jurisdictions are showing growth. Now, I've also found that with my quarterly analysis of sales activity, which I do because it's a forward indicator of what may happen with prices. So we look at those trends because sales volumes means buyer demand, and I've been doing that report, which we call the Price Predictor Index. I've been doing that for 15 years, and I've never seen such strong buyer demand all over the country as we do right now. It's unusual to have such collective strength because Australia's a very big country and we don't have an Australian property market. We have lots of thousands of local markets, but we're seeing growth in buyer demand right across the board. But the biggest level, we're seeing the biggest growth in demand is with the more affordable areas, and that includes units and townhouses. That the unit market is notably emerging very strongly to challenge houses on capital growth because there's more and more buyer demand going to them, partly because they're more affordable, but there's also other reasons, other things driving different buyer cohorts to focus on attached dwellings opposed to detached houses. So there's some very interesting things happening in the market at the moment, and it all points to 2026 being another very strong year in real estate in terms of price growth. There are those amongst the economists and some sections of politics who say prices just can't keep rising the way they are because there's a separation between incomes and house prices. But the reality is they do because we have such strong demand at a time where everything that matters is in short supply.
What's your thoughts on, like, towards the end of 25, early October, we made the changes to the first home guarantee scheme, which is a fiscal stimulus, I guess, to policy that opened up the scheme to essentially no cap on the income level required to enter the scheme and also increase the prices, when really that's obviously only increasing demand on an already stressed asset. So do you see, I guess that's going to just, like you mentioned, fuel the prices in 26 and help the capitals keep up or then potentially outperform the regionals?
Yeah, look, I mean, firstly, it's just another example of politicians who say they care about the housing crisis and the shortages and the higher rents and the affordability problem, taking decisions that actually make it worse, not better. They're not dealing with the core issues at all. They're just going for a populist measure that they might win them some votes at the next election, but thereby fueling demand and making prices rise more and affordability worse. It's not the only factor in play, it's a factor, and we also have very strong population growth through migration. That's been blamed by many, but it's not the cause of the problem. It's just making things a little bit worse. We've had some interest rate cuts earlier in the year, and a lot of people, I think, overrate the influence of that. It's part of the equation, but it's not the biggest thing. I think one of the things is that we are great believers in infrastructure investment as a driver of residential markets and particularly outperformance. And right now we have an unprecedented level of infrastructure projects happening around the country. We've got motorways, airports, rail links, hospitals in particular, very big business, university campuses, data centres, that's becoming huge, and big data centres being established. These infrastructure projects generate lots of economic activity, lots of jobs. Out of that comes demand for real estate. So that's the reason why so many markets are strong, I think, around the country, because this very important part of the equation is happening at unprecedented levels in Australia, $900 billion worth of infrastructure projects. It's also a reason why we have shortages in the housing market, because there's a shortage of tradespeople. So many of them are working on these big infrastructure projects. And so builders and developers can't get the tradies they need, and that's causing projects not to happen or to take longer than usual to happen and to cost a lot more than they normally. One of the reasons why they cost a lot more to build new dwellings in Australia is because of the shortage of tradespeople who are off working on these big ticket infrastructure projects.
And that's the real issue, isn't it? Which is on the supply side, when changing fiscal policies like the first home guarantee scheme to increases demand, when the real issue is on the supply side, isn't it? So, I mean, what's the solution there? Like, we can't just create more tradies overnight.
No, we can't. Well, one of the things we have to do is we've got to deal with I think the biggest single issue of all the issues is that it costs so much to build new dwellings. What are the components of that? Well, 40 to 50% of the cost of a house and land package is taxation, essentially, taxes, fees and charges, all three levels of government. And they're addicted to that revenue. It's like cocaine to politicians. So they're not going to let go of their addiction very easily, but it has to be addressed if they are serious about dealing with affordability. The reality is also that it takes twice as long to create a new dwelling now than it did in the 1990s. So over 30 years, we've got twice as slow at creating new homes, and that obviously adds to costs, adds to all the problems. And why is it so much harder? Well, because of bureaucracy. State governments love tinkering with the housing market. They keep changing the design rules, and every time they do it, they add 10,000 or 50,000 to the cost of creating a new dwelling. Measures to make housing safer, measures to make housing more energy efficient, measures to make housing more accessible or to make housing more aesthetically pleasing. There's measures to insist that every new dwelling has to have not just one lock-up garage, but two, which adds to the cost. All these things add massively to the cost of creating new dwellings without increasing supply, which is what we really need. So they're just making the problems worse. There's also a whole lot of government energy, particularly state government energy, going into crackdowns on landlords, crackdowns on real estate agents, with underquoting, for example, crackdowns on builders. They keep changing the rules that govern the relationship between tenants and landlords, always in favour of tenants. And all these things might be applauded by some sections of the community, but none of them deal with the core issues, which are all about shortage and high cost. They're actually making those problems worse by putting their energy into the wrong areas.
And just when we say new dwellings in an area and stuff, we're not talking about mum and dad developers building even a duplex or anything, or building a new investment property. We're talking about large projects with master plans that are actually going to move the needle on the new supply on the supply level, not the red tape for the mum and dad, but the larger project.
We've got a situation in Australia which I haven't seen, and I've been doing this for 40 plus years, and I've never seen a situation where builders and developers have approvals, but they're not building because it's not financially viable to build. In the big high rise, the Gold Coast used to always have an oversupply problem. They got the opposite problem now because those 40, 50 story towers just don't stack up financially. They're so expensive to build now. And they look at the numbers and say, we'd have to charge such a high price for the end product to be viable that the market won't pay it. So they're not building them. So the supply that we need isn't happening because of the high costs and the bureaucracy. So those are the core issues that aren't being addressed but need to be, but don't hold your breath.
Interesting. And as we move into 2026, then just give us your thoughts on the markets and maybe a bit of commentary on each of the 14 jurisdictions you mentioned, and thoughts of what we might expect to see in some key themes for the year.
Yeah, well, high demand in most jurisdictions around the country, but the ones that really stand out that are really, really strong at the moment. So Darwin is leading, is having a bit of a feeding frenzy at the moment. Partly, I think that's a little bit artificial with certain buyers agents sort of descending upon it and buying everything that moves. A bit of a danger signal for real estate consumers, that one. But nevertheless, Darwin's leading on price growth and the increase in demand. But close behind, Hobart has risen very strongly in recent times. So Hobart's making a major comeback, and that's one, and also regional Tasmania. So those are markets that investors might consider because you're buying at the right time in the cycle. Whereas if you're buying in, say, Perth, it's already had 3 or 4 years of big growth. You want to be buying early in a cycle where there's affordability. And so Hobart and regional Tasmania offers that, and you're getting in at the right time. Melbourne's certainly making a strong comeback after 3 years in which prices have been very, very mediocre, and regional Victoria also, keeping in mind, of course, that the taxes are high there and the state government is particularly unfriendly towards investors with its legislation and its high stamp duty and its high land tax. But nevertheless, people are seeing great value for money buying in Melbourne and regional Victoria, so that's starting to rise. Brisbane continues to be very strong. Perth is no longer leading the nation. It's not sort of pumping as strongly, but it's very resilient because the underlying economy is very good. So Perth is still producing some price growth. It's just not producing that 20% 25% a year stuff that it was a few years ago. Um, Signs that some of those regional Queensland markets that have been having feeding frenzies recently, like Townsville and Rockhampton, are starting to look like they're past their peak, but there still will be some growth there. Canberra, you mentioned early in the conversation, and that's one I never get asked about. Canberra. No one seems to be terribly interested in the national capital from a property perspective, but that market is really starting to come strong, particularly the unit section of the Canberra market. And that's part of a national trend which has been gathering pace the last 1 to 2 years, where we're seeing more and more buyer demand for attached dwellings, and they're starting to produce much better capital growth as a result. And Canberra is one of those places where we're seeing that happen quite strongly.
Just there's a bit to break down there, but going back to the Darwin, with what caution would you offer to investors maybe that would consider buying there, but knowing that yes, there's quite affordable. It's maybe the right time in the cycle, and there is growth to be had there, and no one's sitting here denying that. But when it comes through this artificially inflated sort of demand that can enter and exit a market quite easily, and you can be caught holding an asset in it, and what is, regardless that it's a capital, it's still quite regional and also isolated. What caution we offer to investors that are considering buying there with, the high volatility nature of that market?
Yeah, we've got to be very careful because it's so competitive. There's very low level of listings of properties for sale, and so many buyers agents targeting it that there's strong competition for everything that's for sale. And if you want to buy with due diligence as an investor, like have your building and pest inspection and check things out thoroughly, you're going to lose out to the competition, which is creating sort of incentives for people to buy recklessly, to offer more, to beat the competition, to sign a contract without conditions, and that's high risk investing. I would say if you can't invest safely with due diligence, don't buy there. You might have the perception, I want to be part of this Darwin boom, but if you can't buy with intelligent due diligence, then I would suggest you shouldn't, because it's just too risky. There are other places in Australia that are at another point of the cycle where you can buy a lot more sensibly and still expect to get really good capital growth over time. So suggest people don't get caught up in the frenzy. Don't be greedy. Continue to invest with your head, not with your emotions, and get good advice. Talk to people who have experience. A good buyer's agents with experience. You should have a good accountant on your team. You should invest in your team before you invest in real estate. Make sure you're getting good advice. Be willing to invest in research information to make sure you're buying in the right areas and buying at the right price. Be willing to spend a few $1,000s on advice and research before you spend the big money on the piece of real estate, because it's kind of high risk if you don't do it that way.
Yep. So for 2026, would you say that the affordable market and the lower quartile and the regionals will still expect to outperform like the capitals and the top end of town?
Yeah, I believe so. It's becoming harder and harder to find that level of affordability, and more people are focusing on those affordable areas, which have in recent times shown the best capital growth, and it's also we get the best rental yield. So that's where the great weight of buy demand. We've got young buyers who, out of necessity, are buying at the affordable end of the market, helped by government assistance. So that's strong demand, plus investors also looking at that section of the market. So there's going to be strong competition there, and that's where we're going to get the biggest price rises as well. So it's a bit of a double-edged sword, but the numbers in the current situation, very favourable to investors, provided you can get into the market and buy sensibly. And I think the best advice is to avoid those frenzied areas. There's plenty of good places to buy where you can do it sensibly with due diligence that are going to show good growth over time. Don't get caught up in don't be a herd animal, and the herd is stampeding in certain directions, and it can be dangerous to be part of a stampeding herd.
And earlier this week, we saw the Reserve Bank just hold interest rates when a lot of commentary is now switching from the interest rate easing cycle to potential hikes next year. no crystal balls here, but do you see that commentary is shifting just to slow or sort of rein back in some inflation that may be coming back into the market and asset prices?
Yeah, look, I don't think it's going to have a great influence. I think media loves to chatter about interest rates, and some economists think it's all about interest rates in terms of property markets, and I think the record shows that it's not. Whether or not they decide to keep interest rates on hold or maybe have another increase or bring them down eventually, it'll be interesting, but it's not going to have a material impact on what happens with property markets. Regardless of the Reserve Bank's decisions next year, we have very, very strong demand for a product that's essentially in short supply, and that's going to be the key factor. And the locations that have the big infrastructure investment happening and can offer affordability and all those other things that people need, jobs being created, they're going to continue to have high demand and rising prices regardless of what the Reserve Bank does.
And a lot of our audience is current serving or veteran community, ex-serving, and even some defence industries and SMEs. But we might just run through and get your thoughts on a couple of towns. We have mentioned a few of these, but we'll start Townsville. You mentioned it might be past its peak. Over the last sort of 2 years, it's had excess of 30 to 40%, depending on where you're taking your measurements from. But going forward, what do you see for Townsville?
Look, I think if I denominate one regional city as the strongest regional economy in Australia, I'd probably pick Townsville. There's a few other candidates, but Townsville is, I think, a fantastic regional city with so many elements that make it strong. It's had 2 or 3 years of really big growth, and the last 12 months has probably been the leading location in Australia, where every suburb is sort of up 20%. It's extraordinary stuff. The best time to buy there has passed, but if you do buy there now, you're still going to get growth in the future because it's got that strong underlying economy. It's got a big military economy, which is always a big driver in a regional city. It's got international airport, export port, tourism, manufacturing, resources sector, education, all those factors in play. So it's going to be, a really good place. It's just that a couple of years ago you could buy houses in the 300,000s and you can't anymore. It's the same place as a 500,000 now. So those 6-7% rental yields are no longer available unless you buy units. So a little bit harder to get the value you previously could, but the long-term future for Townsville is really strong, I think.
And just looking like 5, 10, 15 years ago, Townsville economy was not that. It was quite weak, I guess. And do you see that the current projects and infrastructure in place that you've mentioned, are they more long-term sustainable? And is Townsville as a market matured to be that actual capital of the north? Or is it just some projects that are pumped into to help the local economy?
Look, I think it is definitely the capital of North Queensland, and it will continue to be. It's got that. It's well established now with those in that important economy. It's got a growing population as a result of that. It's got expansions happening of its medical economy, its education economy. Very important in terms of its the military presence. The resources sector in Queensland is always going to be a big component, and so many of the big businesses have a presence in Townsville that are involved in resources projects. And tourism, of course, is a big thing. So I think it's going to be a place that will just go forward from strength to strength. You've just got to be mindful as investors that it's in the tropical north, and rightly or wrongly, the insurance premiums are a bit higher. Although it seems to me that all of Australia gets whacked with major weather events. It's not just tropical North Queensland. So, but nevertheless, the insurance companies do tend to charge more for insurance up there. You're going to need to keep that in mind.
Yeah. And shopping around, there's huge variance when insurers tend to price themselves out of a certain market. They've got too much exposure there. But we've mentioned Darwin and spoke about that, so we'll come further south to kind of like the Enoggera or Brisbane out to the Ipswich corridor, being that there's Amberley Barracks and then Enoggera. What sort of insights do you have for the southeast Queensland?
Yeah, look, Brisbane's got a very strong future. A lot of people are moving from other parts of Australia to southeast Queensland. The economy is strong. The infrastructure spend is big, even without factoring in the Olympics factor, which is another extra element giving Brisbane momentum. Ipswich City out in the southwest, one of the strongest parts of the Brisbane market. And part of that very strong and diverse economy with lots of jobs out there is the RAF base Amberley,
Yep.
which I know really well because my first I actually came to Australia from New Zealand in 1978, and my first job was on the Queensland Times in Ipswich. So I used to write a lot about the RAF base Amberley, and it's a fact that over time it just keeps on expanding with government investment. One market I'd suggest people as investors looking for affordability and proximity should consider is the Lockyer Valley, where you're heading west from Ipswich out to Toowoomba. Toowoomba is a very strong regional city, one of the strongest in the country, and Ipswich is a strong market. In between, you've got towns like Gatton, where there's
Yep.
not far from the Amberley RAF base. There's a major university campus there. There's a major corrections facility there, which creates lots of jobs. It's a big agricultural community, and it has a level of affordability for investors that you can't get in, say, Brisbane. So that's a good one to consider in terms of proximity to all those important things at a relatively affordable price.
We do love Toowoomba as that satellite capital city market. I think you still get
Yeah,
that capital exposure that piggybacks off Brisbane. So Toowoomba is a market that we've paid particular attention to. But you
yeah,
mentioned the Olympics. I'd love to just quickly touch on that because it is a topic that comes up at the local barbecue quite often. And I kind of, in my thoughts, define it as it's not an event that will trigger anything that people tend to speak about it in 2032. This will happen, but more like you just sort of touched on, like it's a sequence or a momentum of the market.
yeah.
Um, what sort of impacts do you see, or like as in that event, or more over a certain time period
Yeah.
leading into and after?
The research into other cities that have hosted Olympics indicates that there is an impact on real estate markets, but it's before the event. And I believe strongly that it's the infrastructure. Again, it comes back to infrastructure. They're going to have to invest 15-20 billion dollars to prepare for the Olympics, and it's going into not just sporting facilities, but transport upgrades, accommodation, all the logistics that need to be in place. For example, the Sunshine Coast, it's not just the Brisbane Olympics, it's also the Gold Coast, the Sunshine Coast. Toowoomba gets some of it. I think Toowoomba will have the equestrian events, for example. The Sunshine Coast has been waiting for its rail link for a long time. They need to build it before the Olympics because they're going to have hordes of people from all over the world wanting to get to the Sunshine Coast. They're going to be hosting 6 or 7 major sports there. How are they going to get there if the rail link's not in place? So the Olympics is going to be a catalyst for some of these big infrastructure projects to happen, not just the sporting facilities. And that's where the momentum for property markets will come from, and it's going to be from now until 2032 rather than after the event.
Yeah, gotcha. Um, and we'll cross the Nullarbor. Just like we mentioned Perth earlier, but we've got Swanbourne in Perth, and then obviously Rockingham with the Navy. Perth's timing was quite similar, where it had a very long period, almost 14, 15 years of next to no growth, similar to Townsville, and then through that post-COVID really performed extremely well. Do you see that Perth is past that peak and just going forward still an investable market, or what's your thoughts?
Yeah. Look, it's definitely past its peak, but it's not showing any great weakness. There was that period going back a decade or more where the Perth market, on the back of the resources investment boom, had a big boom, and then it had many years of falling prices. That's not going to happen this time, I don't think, and it's not happening now. And I think the reason is that the Western Australian economy continues to be one of the strongest in the country, and there is a big investment from the state government in infrastructure, but also there's been an awareness in Perth that the economy is too reliant on resources and they needed to broaden and strengthen. And so I've had some success with that. And one of the big factors is the investment in Navy vessels, part of, I think, the AUKUS agreement. And a lot of that's directed at Perth. So there's going to be billions of dollars spent on building vessels for the Navy. And that's going to be a big generator of economic activity, jobs in Perth, and just keep the real estate market strong. The thing about Perth, though, is when the frenzy started, say 3 years ago, so you could buy you could buy bargain houses and get 6-7% rental yields. You can't do that anymore. The $300,000 houses are now $600,000, so you need to keep that in mind. There
Sort
are
of lost
opportunities.
yield like Townsville, didn't it?
Yeah,
Yeah.
absolutely. So what drove that initial investor frenzy isn't there anymore. So that's the reason why the buy demand is going to sort of level off. But there will still be buy demand from people are moving there to take jobs, for example. So home buyers are still going to be buying places in Perth, and it's going to be it's going to be a market that will continue to show growth, but it's just not going to be 20% plus anymore. I don't think.
Mm. And then we've got some of the RAF Edinburgh in Adelaide. What Adelaide was probably a mover prior to Perth, a year
Yeah.
or 18 months in advance, and has done again quite well at a very affordable low base for it to
Yeah.
perform. What's your thoughts for Adelaide's market and the RAF people down there?
Yeah, like it's been rising for 5 years and doesn't show. Well, it is starting to slow down a bit. We're seeing the latest price data figures. It's sort of more like 7 or 8% annual growth. We're still very healthy, but I mean,
Yeah.
previously Adelaide was up in double digits. Um, After 5 years, inevitably that price growth must slow down. But again, very similar comments to Perth. Really, very strong underlying economy, which will keep the Adelaide property market solid. The buy demand continues to be strong. The rental demand continues to be strong. But the real bargains aren't there anymore. You could buy in those Elizabeth suburbs in the 300,000s sort of 4 or 5 years ago, and now they're all up in the 600,000, similar to Perth. So the bargain buys and the really high rental yields aren't there anymore.
Mm.
So that's a factor. But because the economy is so strong, um, and it's a great city, Adelaide, and relative to the bigger cities, it's still got an element of affordability. So it will continue to chug along quite nicely, but just not at those extremely high price growth levels for a while.
Yeah. And I guess the final one that's probably got a lot more media attention and headlines for investors at least is Victoria and Melbourne. So we've got Puckapunju and Albury Wodonga, which have quite a good presence of military personnel, but also the Mornington Peninsula, which I know has been red hot with the Navy down in Cerberus. What's your thoughts, I guess, in the current market state there and over the next few years? Because I believe there's quite a gap that will be closed. Would you agree?
Yeah.
Yeah.
Yeah, I mean, and things are rising quite fast in Melbourne. The price data hasn't really fully reflected just how strong buy demand has got in Melbourne. And we're seeing very competitive bidding at auctions in Melbourne now, right across the market sectors, but most typically in the more affordable areas. Like Melbourne hasn't had any growth for about 3 years, and now it's starting to rise again, as it inevitably must because it's one of our two big cities. It's a great city. It looks very attractive from a value for money perspective because it's much cheaper than Sydney. It's now cheaper than Brisbane. It's on a par with Adelaide and Perth, and really Melbourne should, in the hierarchy, it should be at least our second most expensive city. So there's a bit of a gap to close, and investors have been reticent because of the higher taxes there and the attitude of the state government. I think people are looking at the value in Melbourne and saying, no, we're going to have to overcome that objection and get into this market because there's great opportunities there. So I think if we're having this conversation in 12 months' time, Kane, I think we're going to be talking about Melbourne as a price growth leader in the country in 12 months' time. It's really turned around quite quickly.
I really look forward to that conversation. That should be very interesting to see what unfolds and how the
Yeah.
numbers look. But what about for like regional Victoria, like your Albury Wodonga, Ballarat, and Bendigo's?
Yeah, well, some great affordable buying there. The rental yields tend not to be as attractive in regional Victoria. That's a factor. But in some places, they're better than average, like the towns of the Latrobe Valley, heading out towards Gippsland, towns like Morwell and Moe, where the median house price is still in the 300,000s. So you can get those better rental yields there. They're fairly, for want of a better word, bogan towns, but and some people, get turned off by stigmatized areas, but just keep in mind that these are the sorts of places that have shown the best capital growth in Australia for a number of years now. And people go there because they've got all the basic infrastructure people need. It's affordable. and they don't care that the real estate snobs look down on their town. They like it. There's a good, strong economy there creating jobs. So those markets are going to get a lot of demand. Mildura is another one which has attracted quite a bit of investor buying because it's affordable and the rental yields are a bit better. But probably the ones to focus on for capital growth will be, I think, the big three, which are, they get a lot of population drift out of Melbourne, Bendigo, Ballarat and Geelong. They're a little bit more expensive, but there's pretty good value for money buying, and particularly in Ballarat. A lot of suburbs of median prices for houses still in the 400,000s. These are strong regional cities with a major future, and if you're buying there now, I think 5 years from now you'll probably be happy that you did.
Yeah, excellent. And I guess as we come to the end of the episode, what's like a lot of our audience is current serving and the veteran community. What advice can you give the current serving member that's saving to buy their first home or looking like there's still people that are under the conception having a 20% deposit is better? Like, what advice would you give someone to how far should they be thinking to get into the market and solving that getting started equation?
Yeah. No, I wouldn't. You don't need a 20% deposit, particularly if the federal government schemes are there now. And even if you didn't have that, don't let mortgage insurance put you off an opportunity to get into the market now with a smaller deposit. Because if you wait till you've got a 20% deposit, the prices will have moved, and you're just going to be constantly chasing that. That 20% figure is going to get higher and higher in terms of the dollars you need, because prices will keep on rising. So, if you've got a 5% deposit now, keeping in mind the federal government help schemes, and there's also state government help schemes, I would move now, don't wait, because when you look at the numbers, quite often the amount you're paying for a mortgage isn't necessarily a lot more than you'd be paying for rent if you're renting the same place. Maybe it's a little bit more. Sometimes it's no more. But I'd rather be paying, $700 a week on a mortgage than $600 a week on rent, which is dead money, because you're building equity in an asset that will be growing in value. So I know it's easy for me to say when I'm not the young person with a family to feed, etc. But when you compare what you're paying in rent, look, I don't honestly know the situation that people in the military personnel, whether that they can access rentals at some sort of subsidised rate, makes it a bit easier. But weighing up all the numbers, I would suggest that it makes sense financially, but also from the viewpoint of your future. If you've got some sort of deposit together to get into the market now, if it takes another 2 years to get 20%, think what the prices will be in 2 years' time.
Yep. And any final thoughts or advice to the Australian Defence Force members listening about probably maybe for the investor they've got their one property in that, and what advice can you give?
Yeah, I mean, I always say to people, start as young as you can and keep going. You don't need to be in a huge hurry. But if you, over time, accumulate assets, I think you should buy good assets and keep them. Don't buy and sell. Build a portfolio. Be willing to invest in advice and information to make sure you're making good choices, because you've got a better chance of being successful over time. You get the first one right through having invested a bit of money in advice and information. It makes it easier to get the second one and the third one, and just accumulate. And by the time you get to a certain age, you might have the option to retire early, or you'll have financial choices at age 40 or 50 or whatever that you wouldn't otherwise have. And you don't need a portfolio of 20 or 30 properties to have that financial freedom. Once you get 3, 4, 5 properties under your belt, you're in because the way values are growing in Australia, the equity gets created. I've seen properties in my portfolio double in 5 years, and so the equity that's created very quickly just gives you options that you don't otherwise have.
Yeah, and if I can echo one thing that Terry said there, start early and start young. Time is our most precious resource that we can't buy no matter how much money we have. So if you start while you're younger, you get just so much more exposure to the growing market and potentially more cycles from starting in your early 20s to, early or late 30s. The impact in the back end of that compound effect of this exact same portfolio can be huge. So, get into the market however you can, I guess.
Yeah, I think so, and it's not necessarily easy, but there is assistance out there, particularly if you're starting out for the first time with your first home. There's lots of advantages in being a young person buying your first home.
Excellent. Well, Terry, I've loved having you on the Defence Property Podcast. I look forward to doing it again. I really appreciate your time. If people want to follow along Hotspotting, what are some of the best platforms to follow?
Yeah, look, we're expanding our offering with the portal all the time. We've actually won 3 national awards for innovation in the last 12 months because we're putting so much resources into expanding what you can do on the portal with technology. You can search any individual property in the country. You can get information on any suburb or town in the country. You can do searches like, these are my buying parameters, this price range, this location, this is the type of property I want. And one of our search engines will give you a list of everything that's available. So there's a lot of different tools there for our various members. If you want to get a lot of knowledge, sorry for the shameless plug, but I've just published this book, Why Property Values Rise. For an investment of about $30, you can get probably all the knowledge and information I've gathered over 40 plus years. I've tried to distill it into that book. It's a good one to read if you're sort of a young person starting out. In particular, the sections there's a chapter called the 12 rookie errors that people typically make. If you can avoid making those errors, you're going to be a long way down the path of success in real estate, because if you make some of these typical errors, it's really going to sort of make it harder to get where you want to get with property investment.
I've got my copy, so can't recommend it enough. And obviously, we're a platinum partner with Hotspotting, so jump on and grab a copy of Why Property Rises. Again, Terry, thanks for your time. Really appreciate it. Look forward to doing it again.
Okay, Kane, nice to talk to you today, and nice to have that element of defence personnel in the mix, and talking about the locations where they're typically located. It's a good perspective to bring to it.
Brilliant. Thanks, Terry.
Okay.